involves money. So if you give the customer a free product, that doesn't involve money, that goes to COGS. But if you give the customer money, that cannot go to COGS, that has to go to revenue. So in the case of the supermarket, if you buy 10, you get the 11th one free, that's a fulfillment cost. That's a product to fulfill it. However, in the supermarket example, if you pay rent to them, it's a form of discounting. I'll give you a discount if you give me a good shelf. If you give me a bad shelf, I won't give you a discount. And when it's a form of discounting, it goes against revenue. So for it to go against revenue, it has to involve money. It wouldn't go against revenue if you give the customer goods. That's a cost of fulfillment. That's a cost of fulfillment. I suppose there could be a very strange example of barter where you don't pay in money, but that would be very unusual. So the transaction price includes the variable amount. It includes any non-cash consideration. And what we were speaking about earlier is a consideration payable to a customer. That's when you give money back to the customer. Incentives. For it not to be part of variable consideration, there has to be a separate performance, a separate PO, separate benefit to the vendor. So, if I say, for example, whatever your sales are, I'll give you 2% towards advertising. So if you sell 100, I'll give you $2 for advertising. Does that go against revenue, or does that go to advertising cost? It depends. If it's a reimbursement of a direct expense, the vendor would show that as advertising expense. If it is not a reimbursement of an expense, you have the money to do as you like, then it goes against revenue. So there has to be a separate benefit to the seller. And for the separate benefit to the seller, there has to be a direct reimbursement of a cost for them, such as advertising. If it's just a marketing allowance to do what you like, and they don't have to spend it on marketing, then it's simply going to be against revenue. See the difference there? And it's a direct reimbursement. Correct. Correct, for Coca-Cola. And what normally happens is Coca-Cola would ask for receipts. So when I've seen this done in practice, Coca-Cola says you could spend X amount on advertising. What happens is normally Carrefour would give them the receipts, or Carrefour would say, here's the invoice from the advertising company, you pay the bill directly. As opposed to just giving the money to Carrefour to do as they like. If it's to Carrefour to do as they like, it's a discount. Okay? So the non-cash consideration would be like a trade-in. So if you trade in your old car for a new car, that's non-cash consideration. So the variable consideration is going to basically be everything involved to get the transaction price, but it doesn't include bad debts. So bad debts is not part of revenue. When they first came out with the exposure draft in 2010, the initial idea was for the amount in revenue to be the amount net of bad debts. That was the initial exposure draft. And they changed it. So it's very explicit now. Bad debts is not part of revenue. So revenue includes discounts, rebates, price concessions, if there's a performance bonus, penalties, any sales-based incentives, royalty incentives, that's all variable consideration. Now, if you give an incentive to the client where you say, if you sell 10 cars, you get a trip to Japan, that's a fulfillment cost. But when you give the client money, that would go against revenue. So when you give the client, goods, that doesn't go against revenue because you're actually giving them, that's part of your performance obligations, one of the promises that you have to deliver.
Does sales return have an impact on this?
Yes, you have to estimate those. So when your variable consideration, you estimate your return. So when you I guess the difference is the old standard. If it was to like a wholesaler who then sold to the final customer, and the goods could be returned, you wouldn't recognize any revenue until the goods went to the final customer. That was IAS 18. Under IFRS 15, you recognize revenue based on the estimated amount you expect to be returned. That's a change in the standard.
So what would be the double entry?
Well, you would have a return asset. So there's a new concept in IFRS 15. So when you look at inventory, I have this on a later slide, but there's two types of inventory. And was that return assets? So in IFRS 15, there are two categories of inventory, and they have to be separately disclosed in the notes. Inventory you have, and inventory that your customers have that you expect to be returned. In the old standard, what we used to do is simply make a provision for the profit margin. In the new standard, we have to show that asset to be returned as a separate amount disclosed in the notes to the financial statements.
For example, if we expect that 5% of the goods will be returned to us, and the cost of the inventory that is sold is 100 rupees. So do we credit the inventory by 95 and 5 rupees is credited to the right of return?
Correct.
No, we will credit the inventory by 100 and debit the cost of goods sold by 95 and debit the remaining 5 to the right to recover asset.
In other words, the right to recover assets is the amount of assets you expect to be returned that are in the market.
And we'll debit the accounts receivable by 95.
The selling price would not be 100. It could be something like 120 or 30.
Yeah, the error will be reduced by the gross amount. So that's a key change in the standard here. So the thing about variable consideration that gets really, really messy is it has to be estimated. So you include in the variable transaction price, and what the standard says, it's highly probable that it won't reverse. So again, in IFRS, probable is over half. In US GAAP, it's over 70%. Highly probable is a term only in IFRS, which is the same as probable in US GAAP. So if you think about this for a second, it's going to bring in a lot of estimation, right? So when you book the phone revenue, it's based on roaming, part of it. And it's based on the roaming fees that are highly probable of not reversing. But if it doesn't meet the threshold of highly probable, it's not part of the contract price. You have a lower contract value, a lower amount allocated to the phone. So there's a lot of subjectivity here, and I expect there to be a lot of arguments with your auditors on this, right? Because the auditors are always very conservative, right? And the clients are always very aggressive, correct?
Sometimes.
Isn't it almost always?
We've got friendly.
It depends whether they have achieved the budget or not.
Yeah.
No, the kind of IFRS literature we are receiving, clients usually say that you have written it, you understand it, you tell us the solution.
And from auditor independence, you're supposed to say, I can't. You have to do it yourself. You're supposed to check it, right?
For that, we have consultancy wings.
In the same firm.
Yeah.
And that's what Enron did with Anderson, right?
No, not really. Anderson and Enron were different things.
Yeah, but they had consultants to design the product, and they audited it as well. Usually what happens is if you're listed on the stock market, what normally happens is the auditors cannot help you. And if you're not listed, it's more flexible. So it's probably here in Pakistan, right? So if you're listed, you probably can't go to your auditor to have them do to execute it. But if you're not listed, there's usually more flexibility.
The only exception is tax services.
Even that
Yeah,
is
tax.
more there.
Yeah.
Every other day, these things are getting stringent. What I was trying to say is, whatever is happening, there's no deviation from the principles. But it's getting complicated.
It's getting too judgmental, I think.
Judgmental and complicated. Data-driven, process-driven. There's a lot under one single sentence as we are looking at this contracts, unwinding the contracts, understanding them, identifying if there is a service contract or a lease contract, then instituting the procedures
Exactly.
that can continuously give the information. So I think they are making things a lot complex, and when you apply IFRS to every institution, the principle or the concept of scalability is compromised. There are smaller entities, those don't need these kind of judgments.
I think one of the big issues we have in IFRS in your country is if we compare it to the UK, for example. Who in the UK uses IFRS? You're listed. And if you're not listed, the UK has different types of accounting standards. So IFRS is only for listed companies. If you're not listed, they have two sets of accounting standards, or a couple of them, for smaller companies. And if you're really small, they have a super easy set. I think the problem in what I see in the Middle East and the problem here in Pakistan is everybody uses IFRS, correct? Whether you're listed or not listed, which is crazy. Because what is the purpose of IFRS? If you go to the objective of IFRS, IFRS is designed for listed companies. So if you're not a listed company, why do you use IFRS? Because someone made a rule to use it, right? If you compare it to the United States, in the United States, who prepares accounts under U.S. GAAP? Only listed companies. So the average American chartered accountant, or CPA, we don't care about U.S. GAAP. The average American CPA, for the most of the firms in the U.S., don't use U.S. GAAP. We look at management accounting. We look at tax accounting. U.S. GAAP is irrelevant. U.S. GAAP is only relevant if you're listed. So then you go to these emerging markets where it's a more challenging environment, and you say everybody must use IFRS, which doesn't make any sense, right? But it gives work to the auditors, right? Yes?
In variable consideration, it's mentioned sale and usage-based royalties.
Yes.
So does that mean the amount of royalty, for example, if Honda is giving on the amount of units sold, it's going to be recognized as a reduction in revenue rather than in cost of goods sold?
Correct.
Because currently it's recognized in cost of goods sold as a factory overhead expense. So it's now going to be recognized.
So you give a rebate to the dealers, is what you're saying?
Not to the dealers, it's sale and usage-based royalty. For example, we are giving 1% royalty of every unit sold to Honda Motor Japan. So does that royalty...
Hold on. From your point of view, it's a cost. From your point of view, it's a cost. This is always from the seller's perspective. So you're talking, the moment you pay and it's a cost, it's nothing to do with, if you pay it to your vendor, it's not under IFRS 15. IFRS 15 is when you're the seller, not the buyer. So what they're talking about there is you pay royalties to your customers. So you pay usage royalties, you pay extra money. So going on to variable consideration here, the key thing here we're talking about is this new concept of highly probable. And what the standard says is if there is uncertainty over a long period of time, there's a limited experience in those type of contracts, there's factors outside your control, or there's a wide range of outcomes, then the variable consideration, you would not consider it. And you book that as revenue when it happens. So the key thing is, and this is where it gets really interesting, you have to recognize the minimum amount that is highly probable of not reversing. If you think about that, that gets academic, doesn't it? You get out your models. Then the auditors go through those models. And you never agree on those, right? So, an example here. You sell some machines, okay, and remember, the issue here is that you have 2 points of time. Today, you get the machine, but the contract has a service as well, right? There's usually 2 points of time. So there's usually 2 performance obligations. Or, today you get the machine, and maybe there's 1 performance obligation where you get a bonus. But usually it gets messy when there's 2 POs at 2 points of time. That's a more challenging one. The phone and the service. In this example here, you have a machine. You sell it for $100 million. And based on the efficiency targets of this machine, you get a bonus. So let's say this machine is solar panels. And you put solar panels on the client's premise. And if you find that any of these factors here are present, then you don't include the variable consideration. Let's say, for example, that for the solar panels to work, the customer has to go up to the roof and take out the leaves. So if the customer behavior affects the bonus that you're going to get, then you don't book the bonus until it happens. It has to be basically, if the factor is outside of your control, we don't consider that. Or if you have limited experience with this type of contract. So in this example here, you would book revenue of $100 million. And when you get the bonus, you book the bonus as it happens. Second scenario, you have same thing. You have a broad range of outcomes, but 95% of the contracts, you get a 3% bonus. So what this means is before you've earned the bonus, if I've given and I've satisfied all my POs on day 1, what I would do is book revenue as 103. So I think when you look back at this part, this gets very, very subjective.